Well, thank you for staying with us. Now, FSDH Merchant Bank has released its Nigeria's macroeconomic report for the first half of 2025, offering critical insights into the global and domestic economic environment. At its Media Economic Outlook Roundtable held last week, titled Balancing on the Edge in a Fragile World, the report dissects the complex interplay of global disruptions and Nigeria's economic performance while providing a forward-looking projection for H2 of 2025. The report identifies global trade tensions, geopolitical unrest in the Middle East, and fragile capital flows as the dominant forces are shaping the economic outcomes of the first half of the year. Despite these headwinds, Nigeria showed signs of resilience underpinned by expanding on oil exports, moderating inflation, and improved investor sentiment. Speaking at the event, Bukola Smith, the Managing Director, CEO of FSDH Merchant Bank, emphasized the importance of resilience and reforms. Now, Mr. Jamiu Kuku is Treasurer at FSDH Merchant Bank. He's live in the studio to make sense of this report. Good afternoon, Mr. Kuku. It's good to have you in the studio.
Good afternoon, Tolu. It's my pleasure.
Thank you. I think I should allow you to give an overview. I'm looking at that trust report, looking at critical insights into global and domestic economic issues, balancing on the edge in a fragile world. Tell us more about this.
Okay, thank you. Thank you for having me again, Tolu. So for that report, we've very deliberately themed it, balancing on the edge in a fragile world. I mean, we're just trying to show prestigious clients all over, just to help them navigate the market, the ecosystem. Right now, what we're seeing, we want to also put some sunlight on events in the market and how to just guide them into the second half of the year. But we're also trying to take like a post-mortem on the first half of the year, what went wrong, what happened, and the learning points from that. It's one of the reasons why we put this together. And I'd like to speak to that.
All right, interesting stuff there. Let's start with the global risk and, of course, a local impact. Israel-Iran crisis, we've seen all that has happened. Trump's tariff issues, the blow that had on oil prices, and all of the global issues that we face generally. How did you guys assess that, and what does it mean for us?
Okay, so I think it's mixed reactions, really. We're starting with the tariff. I mean, we all know the market is very expectant of the POTUS, the President of the United States, and what the statements he makes. So on the announcement of the tariff, I think that sent the market into a frenzy, really. There was a lot of sell-off, a lot of, I would say, flight to safety, flight to quality, and we saw all of that happen as an immediate reaction to the announcement. As things started to settle down, as we know, it put it again on suspension. So the market kind of stabilized a bit. There were signals of normalization returning to the market. Asset prices were rightly priced, and people just began to kind of find comfort in the market again. Just off the back of that was the Iran war, where we saw Israel attack Iran, and some retaliatory impact of that. So on the back of that again, that also had some chaos and some impact on the global market. We saw that, more importantly, in the commodity market, where there were challenges around the Strait of Hormuz, which is like a pathway for oil delivery. And that also sent the commodity prices kind of skyrocketed just around that period. We saw that, but I mean, the duration of that conflict was not so long, and we saw normalization, and the market right now is beginning to kind of reassess, rebalance, and even though we still see some level of risk in the horizon, but I think with this report, it shows like a pointer to where the silver lining could be and where the opportunities could be, and that's why we in FSDH have decided to just come out with this.
Interesting stuff. Inflation moderating. We see a revised CPI in our country, and that brought the inflation a bit down. There are still arguments around that. You would agree with me, talking about the MBS figures and all of that. But do you think that in that report, in your understanding, do you think that we have gotten to that point where the curve starts to tilt downwards for inflation?
Yeah, well, I think it's gradual. I mean, what they've done is, I think, is globally accepted. I mean, we had to do some moderations. The last time this was done was some 10 years ago, and now what we did was just to rebalance in line with current realities. You know, right now, I think the base year was changed to 2024, and there was a weighing rebalancing, things like in the food sector, for example, core sector, and all of these things are, I mean, because we need to have a contact to reality, and that's what that did for us. And we saw that there was a sharp drop from some 33% levels. It came down to about 24.5 thereabout. Yeah, there's still questions around how does it really impact demand on the streets and all of those arguments. But with time, I think these things will permeate the system, and there will be normalization. But right now, what we did, with a couple of other reforms that are ongoing, I think we'll have to take everything as a bulk. We will find that there will be gains out of it. I mean, it's gradual. I mean, like the inflation rate also came down on the back of commodity prices, food being a contributor to that. I mean, we now have less of tension in the agri-producing communities, and we've seen that we can actually move commodities, foods more easily, and that segment of it has kind of tamed or reduced the impact of inflation. And we hope that will continue. I mean, I think the guys at the helms of affairs right now they're very deliberate about the outcome of the reforms, and we're beginning to see all of that.
Indeed, the reforms, exchange rate reforms working. In Nairas, there's been a bit of stability. I would also agree with that. We know what we used to have from the other market, and of course getting effects from the central bank before now. But that disparity seems to have a bit been reduced to a considerable minimum. But what do you make of CBN's efforts, or in that your assessment, in of course transforming? Do you think that confidence is back as expected?
Yeah, in the FX market, I think to a large extent we've been able to kind of restore confidence. The monetary authorities have been very deliberate in achieving this. There's been a set of reforms really. We've moved to electronic trading, where there's more transparency around markets. There's more governance around the market also right now in the FX market. And we've seen that they've consistently intervened where and when needed. All of these things kind of restore the confidence. And also we've given yields, we've given kind of yield, I would say abundance, yields, and now I think we're now able to hold the FPI's hostage to our yield quality. I was seeing that they are more interested in what we're offering locally. All of these things added up to what we're seeing. Now, in terms of is the confidence fully there? Yeah, like I always say, there will always be pressure points, times where there will be volatility, largely also because of external factors, you know, but we've begun to trust the CBN that they can always salvage the situation, just like they did in the times of the crisis, where rates got as high as 1.6. They were very able to consistently intervene in the market and moderate the rates. So that outcome has also instilled a lot of confidence in the FPIs, and they find that the quality of yields they get here now, probably they can't match it elsewhere. So, I mean, all of these things. And stability really is what they need. So, I mean, they've seen that for a while now. It's been stable for over 6 months, even though there could be some oscillation there and there. But I think we've made an announcement, like we are ready to play. I think that's the statement.
I think we're ready for business.
Ready for business.
That kind of line there. But the positive growth indicators are also something that was highlighted in that report, talking about PMI now above 50 threshold, 50 points threshold, beg your pardon, throughout H1. What sort of reflection? Expansion, agriculture, industry, services? What are your thoughts around this? Yeah,
I think everybody's just getting to work, and we're beginning to see the results of that. Agri, for example, like you said, the PMI, Purchasing Managers Index, has shown that improvement. We've moved from levels of 50 in January to about in May we were probably about 53 along agriculture, industrial line and service sector, which shows that there is growth. And more importantly is that there's still room for improvements. I mean, in the economy that we are not at best utilization right now, so there's room for growth. And I think all of these things with diversification, I've also seen that large contribution to all the income we've made, the revenue, we're beginning to diversify largely away from oil, which has been the main source. So we've seen that agric is now also giving us a strong contribution to that pool, and we've seen that also in the service sector, a lot of activities going on. The digital economy is also supporting this course, and we've seen that the prospect still remains very bright for the nation.
I'm seeing some of those reports, some of the graphics there on TV, you know, looking at how it was before now and how we've seen the flip-flop. But let's talk about oil revenue pressure. You just touched on that too. And this shortfall might affect our, of course, fiscal performance.
Yeah.
What options do we have?
Okay. So, I mean, I think I talked on one very importantly is that, like you said, clearly, the projections we made coming into 2025, I'll say we're a little ambitious. Going by, we've set oil benchmark price of $75 per barrel, production capacity of about 2.06 million barrels, and these things are, especially when the factors are more exogenous to us, that we don't really have that full control over. But so we might definitely have a shortfall. But in terms of capacity to fund those shortfall, I think we're also better positioned. Going by the sincerity of purpose around the reforms, and people are beginning to believe in the reforms. So I think it's also improving our credit quality. We've also got some rating upgrade from Moody's and Fitch. So all of these things put together would ensure that you're able to tap monies from the offshore markets at rates that are very sensible and not too punitive. That's on that side. We also made a payment. The rapid payment to IMF, we paid the principal sum of about 3.4 billion. That's a show of strength on our credibility. I mean, all these are things that are driving traffic to our base. So definitely we can cover for that by diversification, a lot more diversification. We've seen what agri can do for us. If we can diversify more, the telecom sector is also some very potent sector that we can also drive from. And I think, again, what we should focus on is to try to onshore production and maybe import substitution where there are local alternatives. So we can begin to develop our own, I'll say, trajectory or income pool separate from maybe oil or crude reliance that we've always had. So we can have a diversified sector and income coming from various segments of the economy.
Brilliant stuff. Before I go to capital market strength, let's talk about the tax reforms.
All right.
Which, of course, it's still top in the news, you know, for bills, now laws, and a lot of expectations are about how this will harmonize the tax system. The very big one is raising that tax GDP from about 10-11% to around about 18%. You're nodding already. Take it away. What do you make of that?
Yeah, I mean, that's another step in the right direction. Yeah. I mean, because we need to explore this. I mean, we've always been one of the lowest. Around this geography, really. It's been 10%, so doing this would kind of give us some rebalancing. I mean, I think it's fair. I mean, on the CGT, there's going to be an increase from 10 to about 30 on capital gains tax. But again, places like SMEs now, you have more room. You have to be doing like a turnover of 100 million before you're subjected to tax. And VAT on essentials have also been taken away. So in a way, it balances a whole lot of this. It's not exactly intended to be punitive. I mean, it's then also on the administration and the compliance on tax payment. These are things that will make it easy. I mean, if it doesn't overburden your pocket as tax, then I think people will voluntarily, be more willing to make tax payments. So I think it's a step in the right direction. If you are getting that 800 basis point increase in your generation of tax, I think that would go a long way in transforming the economy.
You know, many want them to just expand that net. We don't want to increase. We don't want it. That's always the discussion everywhere. Like, no, just try to expand the net, get people that are not paying, let them come into the net and not just overtax on people. And we expect the rich to be taxed even more. If you look at the breakdown of what Mr. Dawidele worked on, the chairman of the committee, he says it's pro-poor. So if really it's pro-poor,
I kind of agree with him that it's pro-poor.
Yeah, really, if you look at it, the basis for the salaries and all of that. Let's move to talk about capital market now, in your report, it shows that the returns of 16.6% year to date outperformed many global peers. If you look at what that means, and also foreign portfolio investment surged to over $5 billion US. That seems to be very impressive.
It is. The market has returned. It has given quality return, I would say. It's also largely because that's also some spillover benefit from the reforms we've done. We've been able to stabilize currencies, so people can also, we've been a destination for capital, really. I've seen that. Again, largely, I think some of the decisions to also benefit from the market is because I think the fixed income market also lost some, I would say, some true yield, some true return. It's probably not delivering as much in terms of the yield compared to the return. And for people that are risk on and feel they have more appetite to take on some risk, they've decided to go to the capital markets, and we've seen that play out on equities. And very particularly, some corporates have done very well. Performance, the results released so far have shown that they've done so well. Banking, for example, telecoms, and this is expected to continue to the second half of the year. Going by the recapitalization agenda and the plan, people also believe that as banks begin to raise this capital, their capacity to do more increases, and for more should be given to those that can do more with it. So, even
today, the market is starting the week positive. You can see the figures there on the screen, 0.18%. That's the figure from the NGX today. And we've seen that positive performance in recent times. What do you also make of that?
Yeah, I think it's just it's the momentum. We need to ride on that momentum, and the affinity, the interest everybody's peaking, and I will still continue to hammer on it that these are just the effect and the outcome, the positive outcome from the reforms we've done, and I think globally we might not be able to see that quality of return because mostly they're almost peaked out. They are peak at their return quality. So this jurisdiction and this geography still has more headroom for returns. So we will see people continue to come in. And again, if you have an exchange rate at 1.5, for an FPI, it's easy for them to buy a lot more. The value they are getting of the exchange rate is also very, very interesting to them and compelling. So I would see them always want to come in. And the corporates are doing pretty fine. The results, as we've said, are doing very good. So we expect more of this to play out in H2.
So H2, what are the projections? Are there any quick wins? What are those, let's say, in the short to medium to long term, in your report?
Okay, I think firstly, as investors, we need to be long-term greedy, not short-term greedy.
I agree.
So if you're looking at that, quick wins are, let's first of all continue with the pace of the reforms, to cement the confidence, more importantly. Last time I spoke, I said we are seeing FPI flows. We'll be interested in seeing FDI flows. And that shows a level of, is a notch higher in terms of the confidence level. So we'll look to see that. In terms of the banking environment, I still think there's more room for growth and there's more potential for yield, for those that are yield hunting, and that's a place to look at. And if we continue these reforms, in the fixed income space, for example, I know there's still a lot to borrow in terms of what has been raised compared to the deficit we need to fund for H2. There's quite some stuff to borrow, but even in the mix of that, there will always be opportunities that will direct the yield curve. Even though I know the DMO and the government right now, they have a chance of bilateral borrowings at very sensitive and interesting rates. So I'll suggest that there's still a lot of opportunity in the ecosystem in this space for that. So fixed income opportunities, equity, like you said, I mean, they're not slowing down anytime soon. I think there's still a lot to capture in that. So H2 still looks very promising. The only fear factor we have right now are maybe external factors. If there's no escalation of, say, wars in the Gulf region, things stay stable, and also maybe Russia, Ukraine, we can broker some truce around there. The supply chain issues that we are having, we can have a smoother supply chain. Because we've seen people start to kind of diversify their supply chain. A lot of these things have a very negative contribution to growth. So we need to have peace, global peace, to ensure that the dividend of all of these things get delivered to people. So if we are not having issues around oil production, the pricing is good. I think for us on the revenue side, it will still be good. And fiscal prudence is also something we need to be very careful about. We cannot continue to escalate costs or escalate the deficits. I mean, globally, there's been so much talk around deficits, and it's becoming a worry, even to the U.S. As big as the economy is, I mean, it's becoming a worry. So for us, we need to moderate some of our ratios, some of our ratio indicators, things like revenue to GDP ratio, debt to GDP, and all those things. They need to look, I mean, prettier for the investing community to continue to patronize us in the space.
Mr. Jamiu Kuku, I must say it's interesting really having you. It's the first time on the show. Hope to have you again. Treasurer, FSDH Merchant Bank. Let me get a handshake. I wish you a great week and a profitable one. Thank you so much for coming through. All right then. Well, indeed, that's our package for the first work day of the week. I told you earlier that the market